All right. Well, good morning. We've got a bit of an overcast day here in West Lafayette, but nonetheless, uh, we'll uh, we'll keep it with a gloomy topic, right? Government debt. You know, I think what's interesting about the sort of conversation about government debt in a class like this is that it is going to become much more important in the future, right? So, in the same way that prior to the 1970s, when you taught, macroeconomics, especially if you were teaching, mainstream Keynesian ideas, you probably did not talk that much about inflation, right? It was probably not as much of the focus. And then, of course, after the 70s, inflation becomes very much a focus, and we get expectations and Phillips curve and all this various stuff. And a topic that I think will definitely need to be more covered in future intermediate macro classes is the macroeconomics of debt, as it were. I think the reason why, if I think back to when I took my intermediate macro class, which was in 2006, I believe, when I took intermediate macro, uh, debt was not really as much of an issue at that point. I mean, the U.S. had debt, like don't get me wrong, but we were about what 7 years at this point removed from a balanced budget when the U.S. literally had expenditures equal with tax collections. Now, by 2006, however, there had been significant upward pressure put on debt. So we can sort of start from, let's just start in 2000, and we'll sort of put this as, balance, right? So we had a balanced budget at the tail end of the 1990s. And so we'll kind of start there. Now, the reason why, let me, sorry, I'm too zoomed in on my whiteboard here. There we go. All right. So 2000, and oops, I think I'm probably too far. There we go. Because I'm totally a professional here. Okay, so 2000, and we'll say we'll just put a B there for like balance, right? So the federal budget was essentially balanced, and then there are, of course, a number of things that happen in the early part of the new century. There is a recession in 2001. The Bush administration pursues fiscal stimulus, both in terms of increased domestic spending as well as a tax cut. And I remember back in the early 2000s getting the Bush tax cut stimulus checks, and then sort of looking back on it, as sort of the beginning of this real dislocation between policy and ultimately a balancing of the U.S. budget. And so, when we think about what are all the sources of debt that we can kind of go back and say, okay, this is where really the debt starts to kind of creep up for us, and then we'll kind of speak more to kind of the structural side of how this sort of fits into kind of the modern U.S. budget, and then of course we're going to cloak everything here in terms of what we know theoretically and empirically about debt. So anyway, so we go here, and we have a tax cut, we have spending increase. So right off the bat, there's a deficit. Just literally in terms of how we go in to the early 2000s. Like there is now going to be a fiscal deficit. Now, this is not very Keynesian, of course, because also what's going on in early 2000s is the economy is doing fine. In fact, we're in the middle of a speculative bubble, the dot-com bubble. So things, in fact, maybe are a little too fine, but things are going well. There's no need for sort of fiscal stimulus at this particular time, but that's the signal being sent. We're going to cut taxes, and then there's going to be this sort of increase in spending. Then you have, as I said, the 2001 recession. Basically, anytime you have a recession, it creates deficits. Spending goes up a little bit because not only are you running the government, but now you're paying unemployment insurance and other sorts of forms of welfare. But then, of course, tax collections also decline. So spending goes up or the same, but revenues decline. So we had a recession that, again, puts us more into deficit. So deficits increase, deficits increase. But then, of course, it doesn't, in a sense, in there, because of course we have then the wars in Afghanistan and Iraq. These increased government spending, so they become deficits, right? We then have Medicare Part D reforms, which also put upward pressure on the deficit. So again, just inflationary, but inflationary also because it is increasing the deficit. The deficit is growing, and why this is so notable is that because in the early part of the 2000s, especially this 2001 recession, it's not much of a recession really. It's really kind of a speculative correction. I'm not as a sort of modern mainstream economist, I'm not big on referring to recessions as corrections. I think that sort of belittles the relative economic misery that is experienced in them. But insofar as a recession could be a correction, a market correction, I think the 2001 recession at least kicked off by that particular idea. But then, of course, the events of 9/11 also, we believe, contribute to, in a sense, the continuing of that particular recessionary pressure. But again, the increases deficit. So just propagate spending, and also realize we had pursued tax cuts at the beginning of the decade, and so by the end of the Bush administration, even if you cut it off in 2007, so prior to the recession, the Great Recession happening, debt had increased significantly, to the extent that was, I think, part of people's tiring of sort of the Republican president as a supposed fiscal hawk, but then kind of turned around and was exact opposite. I think that was at least part of the relative distrust during that time period. And then so we get into now we're in sort of 2008, and we're in really big deficit already. The U.S. is running structural deficits at this particular point. And then of course we have the Great Recession, which again puts upward pressure on the deficit. So deficit sort of continues to go up. We're still, by the way, spending on all the wars at this time, right? Neither of the wars have ended at this point, and so that's increasing the deficit. And then you had things like the stimulus, right? The American Recovery Act, the fiscal stimulus to respond to the Great Recession. That's also putting up a pressure on deficits. And then we go on, and you have the Affordable Care Act, which, despite the fact that it's well-intentioned policy in terms of health insurance, and certainly has reduced the uninsured rate in the U.S. precipitously, also puts upward pressure on deficit. Really, you can keep going here. So we go to 2016, right? So after Obama, we're in extreme deficit. So maybe we'll put triple D there, just so we can sort of, that is a lot of deficit already. And then the Trump administration comes in, and in 2017, what do we get? We get a tax cut. Spending sort of continues to increase. So again, deficits continue to go up, right? And then 2020. Right. What do we have? We have a depression, a literal economic depression. Spending goes way up. Revenues go way down, at least initially. And so that put up a pressure on deficits. Then we have, of course, more stimulus. And then deficits go up. More spending. Deficits go up, right? I mean, at a certain point, we don't need to do this anymore. There probably has not been a single fiscal policy position in terms of any sort of large scale policy goals that has led to a reduction in the deficit during the 2000s and up to today. Now, there have been times in which, kind of year over year, the deficit has declined. Notably, if you go back to 2014, 15, there was sort of this downward pressure on deficits, but that was mostly just because the economy was doing so well back in 14 and 15. And so tax collections really had finally come back to their pre-recession levels. And so that's why those deficits were really falling. It was not really any sort of like fiscal responsibility. And I would just point out, by the way, that if we look at this, 25-year period from 2000 all the way up to 2025, this is completely bipartisan. There's nothing that really would suggest that either party is any better on this particular point. I guess the only thing that you would say, just sort of from a political perspective, is that on the Democratic side, part of their kind of philosophy is a little bit more deeply entrenched Keynesianism, and so deficit spending is fine as long as there's a reason to do it. And so we look at sort of deficit spending during the and after the Great Recession, and then certainly after the COVID depression as well, and that sort of all makes a lot of sense. But the problem is then there's not really pressure coming from the Democrats to fix the budget issues during good economic time periods. And then kind of on the Republican side nowadays, I don't know, the Trump has so warped in a way kind of their views on some of these topics that it seems that a lot of Republicans have basically shifted to no longer really worrying about the debt at all. And there are some folks, Rand Paul, Thomas Massie, sort of notably, that are continuing to kind of say, hey, debt is a big issue. I bring up the politics of this is because I think it's important for center left, especially economists, who I think sometimes get a little offended at the idea that we're being criticized for being sort of slightly liberal and economist, and then therefore our economic analysis would be inherently biased. Is that especially during the Obama years, I do think that there was a sense that you didn't need to really even criticize spending, that spending was a good thing. And of course, that was mostly because we were in deep recession. But then when we came out of that recession, you didn't then have really much call for, okay, let's get our fiscal house in order. There sort of continued to be this sense that debt was not really a problem, which I find interesting because looking back on it, when we talk about the sources of that debt, it's not good. None of it's good. So it's funny to me that there was sort of a silence on that. And I think it opens up the American left to sort of criticism that that all sort of now there's their concern over debt. But I don't think that it is overtly political, but I can see how politically you could make that particular argument. I am someone who was probably in that particular camp. I had sort of come to see debt and deficits as not that big of a deal. Now, understand, back in 2008, 2009, what we thought was a ridiculous debt situation, we had no idea what was coming down the pipe, right? I never expected the U.S. debt to get, in a sense, this bad. And I've come to see it as certainly one of the biggest issues we have to confront. In fact, if you were to say to me, what are the two biggest economic issues facing the U.S. and maybe globally, because what affects us affects the globe, and things that affect the globe affect us, I would say structural deficits and U.S. debt moving forward, and what I believe will ultimately hamper our ability to respond to climate change in the future. So, my argument as an economist in terms of why we should tackle the debt situation also coincides with my belief that climate change sort of represents an existential macroeconomic problem, especially over the next 50 to 60 to 70 years. And we need to think about how we're going to become more resilient and become more adaptive economically in a world where basically everyone's going to agree we can't afford to do so. And so we're definitely going to be in that kind of tenable position of being simultaneously not able to afford inaction, but also not being able to afford action. And that's, you never want to find yourself in that place. So getting the US's fiscal sort of house in order, I think, is important just in terms of our ability to carry out what we see are as policy goals. And then sort of beyond that, we are absolutely venturing into a territory where theoretically, and previous theories which have perhaps given green light to deficit spending even during good economic time periods, that we're pushing the threshold of that, where we're starting to really, push that idea, I think, to its limits, and I think potentially with bad consequences. So the theoretical idea of debt, in the U.S. is to what extent does debt have an actual sort of economic effect? And I would say that to me, in 2025, the way that debt has sort of number one economic effect is, first and foremost, I think it's representing kind of crowd out in terms of government spending. So I think we're doing less good stuff because we have to pay so much interest on our debt. And then I also think that if you just look at the kind of classic theoretical considerations of what debt financing does to, say, for example, interest rates, I think we're really starting to see that show up in the data. So I think that if you're trying to maybe argue that the relatively high interest rates that we've been seeing recently, and I'm speaking about sort of net of inflation, higher real interest rates, I think that the public debt is certainly starting to buoy that quite a bit. We've talked about Ricardian equivalence, that basically people, their expectations about future policy are generated from current. So if you get a tax cut today, the sense is that people will know that in the future there has to be a tax increase to, in a sense, kind of make up for it. Now, what's interesting about that is that, we've had numerous permanent tax cuts, right? The Kennedy tax cuts were permanent. The Reagan tax cuts were permanent. The Bush tax cuts were to some extent permanent, although they were rejiggered quite a bit. And there's been efforts to make the 2017 tax cuts permanent. So we're putting into we're kind of moving away from the idea of a tax cut sort of eventually going away and being sort of wrapped up with a tax increase in the future. That doesn't seem to be happening anymore. So I don't think Ricardian equivalence sort of really holds up. Barrow found really interesting evidence of Ricardian equivalence in the 50s, 60s, and 70s, but I think that was just a completely different time period. So I don't know how useful Ricardian equivalence as an idea is here, given that fiscal policy especially has really become permanent. I think that there's a sense that the U.S. government is going to attempt to run permanently low taxes and permanently high spending. That seems impossible to me, but that's I believe in arithmetic. So the Keynesian view, and again, I think this is where politically it gets distorted, and that has become problematic. And the Keynesian view was, look, deficit spending is fine as long as the economy is below full employment. Because if the economy is below full employment, then deficit spending is merely going to move the economy towards potential, right? If you're at potential, though, and you pursue deficit spending, you not only get upward pressure on interest rates due to deficit spending, but you also get upward pressure on inflation due to a positive output gap. And then that can feed into those expectations. And we know that the relationship between interest rates and inflation tends to be a fairly important one. Now, again, what we have now, I think, is a reestablishment of some very strong neoclassical ideas, which the neoclassicals were much more concerned about government debt. And again, because they really heavily emphasize the upward pressure being put on interest rates due to government debt. Now, what's interesting in the US is that there is also somewhat of an argument that says that due to our extreme levels of government debt, that this also puts upward pressure on our trade deficit, right? Because it puts upward pressure on our interest rate. The upward pressure on interest rate causes the exchange rate to change, and then so we expect imports to rise against exports. And so, in a sense, one of the arguments as to why we have such a big trade imbalance is in part potentially this debt story. Now, I don't think that an economist would argue that we should try to close a trade imbalance. That shouldn't be the reason that we would say try to reduce debt, but that a consequence potentially of increased debt is increases in imports against exports. And again, so politically that can become very potent. A very modern sort of take, which came in vogue again in that kind of Obama years, was this idea that as long as the economy was growing, G, faster than the interest payments were growing through the interest rate, then in a sense it was kind of fine. Where again we're testing those again. Growth has declined, interest rates have increased, and so we might be in a time period where R is greater than G as opposed to G greater than R. And that, of course, is very, very scary. The scary part here is that the debt sort of there's this context that we sort of sometimes refer to something as a debt bomb. What do we what do we mean by debt bomb? Well, what we mean is that debt accumulates, and then if that's putting upward pressure on interest rates, then the size of that debt is increasing. Now, one of the things that governments can do is they can try to inflate away some of that debt. So one of the things that a federal government can try to do is run sort of counterintuitively expansionary fiscal policy to try to juice inflation. And then if you juice inflation, that is going to bring down, in a sense, your real interest rates, and therefore makes debt a little bit cheaper. The problem, of course, is that in order to do so, you probably have to create debt. So that becomes sort of highly problematic. Now, how damaging is debt, right? What's the story on that? There was this really famous paper, Reinhardt and Rogoff in the early 2000s. It was like incredibly influential. And it was at least in part of the reason why Greece was put into such an austere position following their debt crisis, because what this paper showed was that really high debt to GDP ratios could, in fact, create slow growth. So again, go back to solo growth for a model and imagine how problematic it would be if you had less growth, if the growth trajectory of your economy was turned down lower due to high debt to GDP ratio. Now, what's interesting about this story, and I included this paper, and I included here to tell this story in part, is that paper later on was found out to have a very large coding error, and in fact reversed some of their results. Now, subsequently, you have the Panizza and Presbytero paper that also found there to be this growth consequence from debt to GDP ratio. But that was kind of an interesting time period in economics, the finding out of that coding error and then the questioning of these results. And some people were very quick to say, look, this paper basically gave license to countries like Greece and the EU in particular to really kind of run austerity. And the position now is that you really have to be careful because austerity can also cut into long run economic growth. And so again, it all becomes sort of this balance. The big issue in the U.S. is that, like, moving forward, there is almost nothing suggesting that our structural deficits are going to decline. In fact, every sort of direction of everything is moving, in a sense, in the wrong direction. I mean, tax collections are fine, but the economy is weakening right now, for example. So tax collections may start to weaken. Spending is just up and up and up and up. And so the sort of thing is that year over year, the deficit is just baked into the budget. And so year over year, the debt is just increasing and increasing and increasing. And so, okay, what are we going to do about it? Like, what are we going to actually do? Well, it's important for us to kind of know something about it. So here are different debt trajectories based on different policy projections. And so you can see, for example, that the 2017 tax cut extensions that are being argued in the GOP passed bill is projected to, in a sense, put us on the highest possible debt trajectory. So again, we're talking that the stated preference of Congress through their approved budget is an ever increase in the deficit and then therefore an ever increase in the debt. There's no sense that structural deficits, really for the next 10 years are going to do anything but increase. And again, I remember when we moved from billion-dollar budgets to billion-dollar deficits to trillion-dollar deficits, and it is just remarkably, I think, frightening to look at these projections and think that the idea is that we're going to be adding $2 trillion a year at least in new debt while we're trying to feverishly pay off the old debt due to the increased interest rates, in part, at least theoretically, caused by the high debt. Again, these projections on spending and revenue, just in terms of the way things look, there's just no gap. There's no gap being closed here. Spending sort of is stable, but then so are revenues are stable, right? I think public finance economists such as myself, I mean, we really try to sort of point out to people, like, this is an arithmetic problem. This is not a political philosophy problem. We really need to move past this. And the thing about, like, the debt debate is that whenever I talk to someone about it, they, like, immediately want to blame, like, one side, like, oh, it's Republicans who caused all the debt. And then, of course, you talk to a Republican, and the Republican's like, oh, it's the Democrats that caused all the debt. And then the economists are like, no, it's everybody. There's been no closing of this particular gap. And the only time that gap has even sort of, like, weakened recently is, again, just when we've had so much economic growth that it just happened to bring in decent tax collections. And so, again, you can see here, we get this in 2014, 2015, 2016, you see, like I was mentioning, the deficits were declining, but that was that big revenue piece. That's the booming economy there. And then, of course, spending was coming down back in line with pre-recessionary spending levels. So that deficit declining, I mean, it's a good news. I'm not saying it's not a good news, but it's a little bit illusory of like, there wasn't like a ton of high quality policy going on there. I mean, I guess the best you could say is that the spending came down after the recession. It didn't just stay at that particular level, because that, of course, would make things much worse. So what are the major sources of our debt? It's the stuff that you would expect. Social Security and Medicare. That's almost 30% of debt projections. The story on Social Security is that we actually know what we can do to reduce the debt problem of Social Security. It would not require the difficult fixes, except for those fixes can be somewhat politically difficult. There's some sort of political philosophy in the U.S. that you can't even talk about changing Social Security. And I hear this on both sides. Again, this is not a uniquely liberal or conservative position. That when people say things like, keep your hands off my Social Security, understand that if we're going to reform Social Security, it's probably going to require us to put our hands on it. But Social Security is not so much a problem because it's a funded program. We actually know where the funding is supposed to come from, and in a sense, it's supposed to be a closed loop system, right? It's you pull from an existing amount of money that has been generated from Social Security taxes, and that's the money you spend on Social Security. Now, have governments always done that? Have governments pulled from the Social Security Trust Fund to spend in other areas? Absolutely. That's bad fiscal policy. It's just not a good idea. Should we have done it? No, we did it. We shouldn't do it anymore, right? But so if we just reform Social Security a little bit, maybe remove the tax caps. Right now, the amount you pay into Social Security is capped. So very, very rich people pay more into Social Security, but as a proportion of their income, not nearly as much as low-income individuals. So that's one thing you could do. That would generate a lot more into the Social Security Trust Fund. Medicare is a huge problem. Like, I think, to me, if you ask me as a public finance economist, what is my biggest sort of debt concern going forward, it would be Medicare. Medicare was initially created basically as a healthcare policy that paid for, just like the very few things. So Medicare was not supposed to be this comprehensive healthcare coverage. And when I say it wasn't supposed to be, we didn't design any sort of funding mechanism for it to be that way. And then what's happened is that over time, because it's very politically popular to tell retirees, hey, we're going to cover some of your health care, there has been this reason to sort of continue doing it. And so we keep adding to Medicare. We keep adding to what Medicare pays for, prescription drugs, at-home care, rehabilitation care. I'm not saying we shouldn't pay for those things. What I'm saying is that when we designed Medicare, we did not design it to pay for those things. And at no point have we really stopped and said, hey, we need to design some sort of funding mechanism here because this is completely unfunded. So to me, Medicare is I think, the scariest sort of piece here. Defense and security spending, these are a lot. We spend a lot of money there. About 14% of debt comes from there. I think that, again, when we get political about it, there's a lot of people who say our spending problems are completely defense and defense spending. If we just got rid of defense spending, or if we reduce defense spending, that would be how we reduce our debt. Certainly, if you reduce defense spending, you're going to lower the deficit, and then potentially you're going to reduce the addition to debt. But defense spending does not represent necessarily this large-scale structural problem, because it's in a sense discretionary. Now, you can argue that there's inertia to the spending here because of contracts and the sense that the defense budget is only ever going to go up, and it's not going to necessarily decline. But still, like, Congress can one day decide we're going to cut the defense spending, and then we cut it. With Social Security and Medicare, I just don't. It's not easy. You can't do it. And I think it's far less politically popular to do that. I think people right now would take a little bit of cut in defense spending, in fact. But then, beyond Social Security and Medicare, I mean, the third largest category for debt source in the U.S., or sorry, fourth largest, is interest on the debt. So interest on the debt becomes source of future debt. I mean, this is scary, right? I'm not someone who thinks that we should think about the government as a family budget, and therefore the government should run these explicitly balanced budgets at all times. I do think very heavily, though, that your deficits should be declining during economic periods of growth. I also don't think that you should have structural deficits. I think structural deficits are a bad idea. And so we need to do two things. We need to stop the structural deficits. That's going to require, doing unpopular things potentially with Social Security and especially Medicare, or at the very least figuring out how we're going to pay for them. But that's going to require politically unpopular taxes, most likely. So we got to figure out the structural deficit problem, and then beyond the sort of structural deficit problem, the second piece of that is going to be just getting the economic system to, in a sense, be less, and I would argue maybe weaned off a little bit of all this deficit spending. I think Wall Street, I think businesses and corporations, they love deficit spending. They don't necessarily like the ancillary inflation. Of course, that's why we like the Federal Reserve, because the Federal Reserve keeps inflation in check. But I don't think that they want to see deficits go away necessarily, except in the sense that deficits put increased pressure on the risk premium for the U.S. The 10-year Treasury rates go up. But again, investors are not as worried about that, because they're always going to be probably safe places for their money, even if it happens to be the case that the U.S. Is not one of them, which is kind of wild to say out loud. But that's what's at stake here, I would argue. So long run issues, entitlement spending, Social Security, Medicare, especially Medicare. Any sort of failure to actually have a sane tax code that closes those structural deficits, I think is a huge issue, and speaks to a lack of maturity in terms of our political class, that they just can't do this. They can't get it going. There's plenty of economists that would be willing to help, plenty of economists that could, at the very least, close some of these structural deficits, get the economy in a better fiscal footing, but nobody really wants to listen to those folks right now. And again, the economic system is starting to rely upon debt financing during economic expansions. What that would suggest is that the economic benefit from expansions is somewhat less than we would normally think, and therefore the economic benefits of debt financing is higher than we would think. That's not a good system. That's a fairly bad system. It creates really, really perverse incentives. You think that propagate fiscal policy and low monetary policy are heavily incentivized now. Imagine a world in which we completely stop caring about things like debt and so on and so forth. And then I think what we're starting to be very worried about now. So there's been some conversation in 2025 about this. So it's a potent conversation to be had right now. Is that there is this increase in the risk premium of the U.S. due to the debt situation, right? The credit worthiness of the U.S. In some rating agencies has in fact been downgraded. That the U.S. is seen as a more risky investment, especially when it comes to things like government bonds. So we've seen that 10-year Treasury note bond increase in price and that reflects the increased risk premium that investors feel from a more risky, less potentially stable U.S. Financial situation. And then again, you add on to all of this the sort of macro uncertainty, the sort of sense that the global economy seems to be slowing down and slowing down when we have done nothing to solve any of these particular issues. I think if you're someone who believes in good government, if you're a liberal and you want the government to spend money, you need to care about debt. Because if we don't care about debt, you're not going to get any of that stuff that you want to see. And if you're someone who is more conservative and you're very concerned about debt, but you think that it's only a spending problem, let me suggest that it is not, and it's not going to be fixed by just the other side doing what you think it needs to be done. So liberals need to stop thinking, okay, it's just conservatives who need to change so that the debt problem gets fixed, and conservatives need to stop them. Oh, it just means the liberals need to change. It's going to require both sides changing substantially from what we're doing now, and it remains to be seen, what sort of political appetite we have for such a thing.